This is an alternate version of exercise 9-2 from page 426 of the text, chapter 9, reporting and analyzing current liabilities. This problem is going to take a look at recording known current liabilities. So it says Piper Corporation has a few transactions below. Transaction A, the company records an adjusting entry for $160,000 of previously unrecorded cash sales costing $80,000. And it has a sales tax rate of 5%. And then transaction B, it says the company earned $32,000 of $80,000 previously received in advance for services. So in looking at these transactions, we want to determine what does Piper's liability side of the balance sheet look like as a result of these two transactions. It says prepare any necessary adjusting entries as of December 31st, 2016 for Piper Company's year-end financial statements for each of the above separate transactions and events. Okay, so let's put together a general journal. When you pull up this on Connect, it'll be all set up for you. And let's take a look at the first transaction. So company sells something. Most states or local governments charge sales tax of some sorts. And so when the company sells that amount to a customer, they also have to collect the sales tax. And that's exactly what Piper is doing here. They're collecting from the company $160,000, collecting from their customer $160,000 for whatever it was they sold to the customer. Plus they got to charge the customer sales tax. They'll be forwarding that on to their state or municipal agency in the amount of 5% of $160,000 or $8,000. And so altogether, how much are they going to collect from their customer? Well, the $160,000 for the sale plus the $8,000 for the taxes. So altogether, they collect $168,000. Now, what did Piper have to give up out of its inventory? Merchandise. And so we have to take that merchandise off the inventory, and we do that by what? Debiting or crediting inventory. We're going to credit inventory. Inventory is an asset. Assets have normal left-hand side balances. Left means debit. So to make a normal left-hand balance go away, a normal debit balance go down, we're going to give it a credit entry. So we're going to credit the company's merchandise inventory, and the amount of the inventory that we use up, we're going to debit as an expense called cost of goods sold expense, or just simplified as cost of goods sold. So cost of goods sold gets debited for $80,000. And merchandise inventory gets credited for $80,000. Now the Part B transaction, we have $32,000 of $80,000 previously received in advance for services. So their balance sheet shows a liability of $80,000 prior to this transaction. Somebody paid them in advance for some services they wanted Piper to do. Now Piper has performed some of those services, so that $80,000 was considered to be unearned revenue. Well, now it's becoming earned in part. $32,000 is becoming earned. So the liability account unearned revenue would have an $80,000 credit balance. We want that to go down by $32,000. So what are we going to give unearned revenue? A debit entry for $32,000. And that amount that we've debited from unearned revenue is going to become earned revenue now, in the amount of $32,000. And that's to record the revenue earned for Piper Company.